Hey everybody, welcome to another video. Today I'm going to be going over ChargePoint's Q1 earnings report. They reported this on June 1st, and today we're going to be mostly focusing on this PowerPoint, the presentation that they put out there. They've kind of got a few slides with some information, some of their progress essentially. So we're going to be starting off here with the revenue diversity slide. They break it down by type and by geography. So you can see type on the left side. The blue essentially on these bars is the networked charging systems revenue. So that's mostly sales of the hardware itself. So that's revenue coming in from hardware sales. Then there's subscriptions in orange. That's coming from the cloud subscription, the Assure maintenance subscription, as well as ChargePoint as a service, which does include hardware in there, but it's owned by ChargePoint. So since those are all subscription models, those are all in the orange. And then there's the other category there in gray, making up a much smaller portion of that. Then they also categorize it by geography over here, only by North America and in Europe. You'll notice that both regions have pretty good revenue growth over the first quarter last year. It is lower than in the fourth quarter, but that's to be expected because this revenue is seasonal. So as you can see demonstrated in the first four columns, the revenue grows throughout the year and then kind of will typically decline in the first quarter. But overall, ChargePoint has been growing pretty well. And with that, we're going to be moving on to the next slide here, which is the non-GAAP gross margin. They did mention this a few times on their earnings call as well. So it is good to see the gross margin improving. Another thing they commented on was that the number of units that they sold during the first quarter were below what they were expecting to, be selling. But they are expecting that demand to pick up with this recession. Once it's on its way out, they're expecting more customers to be ordering their charging hardware. So hopefully that can happen, and then, these these gross margins can stay with that, and, ChargePoint would be in a pretty good situation in that case. Now, the next slide here goes over non-GAAP operating expenses. They break it down by the actual expenses themselves in millions of dollars here with these blue bars, and then the operating expenses as a percent of revenue with the orange line here. So you can see that it went up about $4 million quarter over quarter. As a percent of revenue, it did also increase a little bit as well. That can be driven by, not only the operating expenses increasing, but also the revenue not growing quite as much as they were expecting. So I'm not terribly concerned about this at this point in time, but, it's definitely something worth keeping an eye on. Now, moving on to the income statement, we can see revenue up here at the top, with the network charging systems revenue coming in at $98 million, which is up a pretty good amount from where it was 1 year ago when it was $59 million. So again, this is the sale of the hardware itself. There's really no software included, in these revenue numbers. That would be in the subscriptions category, and that mostly is made up of the cloud subscription as well as the Assure maintenance and ChargePoint as a service. That subscription revenue came in at $26.4 million, which is also up a pretty good amount year over year. And then the other category was made up of $5.3 million, which is also up a little bit from year over year. All of these three categories of revenue created total revenue of $130 million for ChargePoint, which is up a pretty good amount. Looks like $50 million or so there year over year. So overall, very good revenue growth for ChargePoint in Q1 year over year. Now, moving on to the costs of revenue, you can see network charging systems coming in at $80.9 million, which is also up a pretty good amount year over year. Of course, these are costs, so you don't really want these to be growing that much. Luckily, the network charging systems revenue grew more than the cost of that revenue. So, between these two numbers here, year over year, it grew about 65%, whereas the costs only grew about 44%. Then moving down to the subscriptions, the cost of the subscriptions also grew a pretty good amount, but still the growth of the revenue for the subscriptions grew more than the costs. So again, they're getting better margins on subscriptions as well. Other category also grew a bit, and each of those categories led to the total cost of revenue coming in at $99.5 million, which was less growth than the total revenue growth there. So overall, ChargePoint's margins have improved year over year. All of this has led ChargePoint to bring in gross profit of $30.5 million, which is very good growth over that $12 million they had a year ago. Then looking at the operating expenses, research and development came in at $49.4 million. Sales and marketing came in at $37 million, which was a good amount of growth over the previous year. Then general and administrative expenses came in at $24 million, also up a little bit year over year. And total operating expenses were at $110 million. So about, $10 million or so more than a year ago. So in the end, ChargePoint had a net loss of almost $80 million, which certainly isn't profitable, but it is an improvement from where they were a year ago, close to $90 million. So they're certainly heading in the right direction. Now, taking a look at ChargePoint's balance sheet right now, you can see their cash-to-cash equivalents are at $283 million right now, which is up a little bit from the previous quarter. But that of course, isn't necessarily coming in from their business operations since they have a net loss. That's coming in mostly from the sale of these short-term investments and as well as some stock issuance that they had throughout the year. They also have $30.4 million of restricted cash. And of course, as I just mentioned, they don't have any short-term investments anymore. Previously, they had $105 million of that, and now that's all pretty much flowed into their cash and cash equivalents line. They've also got $165 million of accounts receivable and inventories of $115 million, which is something they also mentioned on the earnings call, which is that their inventories have been building since they have managed to increase their production, and as they said, the units that they've been selling haven't been meeting their expectations exactly, so their inventories have built a little bit. They spin that in a good way by saying that it's giving them more resilience to any disruptions in the supply chain or anything like that. So of course, that is one of the benefits there, but you still do have $115 million locked up in inventories. Prepaid expenses are at $88 million, and their total current assets are at $682.1 million. Now, moving on to long-term assets, we've got property and equipment coming in at $41.6 million, just a little bit more than it was a quarter ago. Intangible assets are at $90.9 million, a little bit less than they were a quarter ago. Operating lease right-of-use assets are at $21.2 million. Again, these aren't nearly as much as they would be for other charging companies like EVgo or Tesla. Companies that own their chargers themselves that are leasing that land from site hosts end up having a lot more of these assets, as well as a lot more property and equipment assets. So that's why ChargePoint, these lines are a bit lower than what you would be seeing. Well, not a bit lower, but a lot lower than what you'd see from EVgo, for example. Then there's $216.5 million of goodwill. Overall, not that much of a difference from where it was at a quarter ago. They haven't made any crazy expensive acquisitions lately, so that's kind of remained unchanged. And then other assets were at $7.3 million. Not a whole lot changed there either. So all of ChargePoint's assets right now put together add up to $1,059.8 million, which is down a little bit from where it was January 31st, but not too significantly. Then moving on to the liabilities, they have $61.9 million of accounts payable, $135 million of accrued and other current liabilities, and $90 million of deferred revenue. All of these not changed too much from where they were previously. Those three things combined led to their total current liabilities coming in at $288 million, just a bit more than where it was a quarter ago. Then for their longer-term liabilities, you've got deferred revenue, non-current at $114 million, a little bit more than where it was a quarter ago. Debt non-current at $295 million, mostly unchanged. Operating lease liabilities, $20 million, down a little bit, mostly proportional to the operating lease right-of-use assets. Deferred tax liabilities at $12.5 million, just down a little bit there. Other long-term liabilities at $1.2 million, so up a little bit there. And then total liabilities are at $732 million, which are up about $8 million, it looks like there, from the previous quarter. So overall, this is a pretty good balance sheet. ChargePoint is in pretty good financial health, and I'm not worried about them going bankrupt next month or anything like that. They've got a book value of $327 million, which is pretty good, compared to some other charging companies. They have a negative book value because they have so many liabilities. So ChargePoint isn't doing that bad right now. Now, that being said, I still do think ChargePoint is going to probably have to probably issue new stock or take on new debt in order to raise funds sometime in the future. The amount of cash that they have right now can't sustain them for that much longer. We're going to go down to the cash flow statement next year, but you can see that cash flows from their operating activities, those were at $100.7 million. So that's how much they're burning just from their operating activities. And of course, as we saw here on the income statement, those expenses, those are still increasing. So they're going to continue to need to require more cash. Of course, with that is going to be more revenue growth. So that's another thing to factor into it. But nonetheless, they're still going to require quite a lot of cash for the day, in order to get to the day where they have a positive net income, essentially. Chances are they wouldn't be doing that all right now. They would probably do that later on once this recession is a little bit more behind us and the stock is up a bit more or interest rates are lower. So, I wouldn't expect them to be raising money right now, but, they've got a good amount of cash to keep going for probably another couple quarters, maybe, but I would be expecting, them to be needing to raise more funds, within the next year or so, probably. Continuing on with the cash flow statement here, you can see the $92 million of cash provided from investing activities. Most of that was coming from the maturities on those investments that I went over on the balance sheet there, the $105 million of those short-term investments. And then from the financing activities, they brought in a bit there as well. So net cash provided by financing activities was $27.3 million. A good chunk of that was from the proceeds of issuance of common stock. So again, I would, they've got this at the market offering going on right now. And I wouldn't be too surprised if that continues on, if they continue doing share issuances in the future. So that's just something to keep in mind there. I don't view it as a massive negative since they need more cash in order to continue growing their business. Now, there were a few other interesting things that they mentioned during their earnings call. One of those was that their fleet business is growing very well. I believe they said they had like 200% growth year over year for the fleet side of their business. And I think most of those units are DC fast chargers. So good news there. Another thing that they mentioned was, there was this question about the Ford and Tesla partnership using the Tesla North American Charging Standard connector and, what ChargePoint thinks about that. And they basically said that they view it as, they basically said that they don't view it as a negative thing at all in the long term. So it sounded like they were pretty open to adopting this connector. It did sound like they were possibly thinking of doing something similar to what Tesla does at their superchargers with a magic dock, perhaps. They were kind of vague about it, but they said that they wanted to deliver the experience of having both CCS or J1772 alongside the Tesla NACS connector without having the additional cost of adding a second cable to the unit, but also not needing the driver to carry an adapter for it. So the only thing that I can think of is something similar to what Tesla does with that magic dock, where it's essentially an adapter that's locked onto the end of the cable itself. I'm not entirely sure what their plan is, but it did sound like they're planning on implementing the North American Charging Standard from Tesla. It sounded like they were heavily looking into doing that at the very least. But overall, I think ChargePoint is one of the better EV charging companies you can buy at the moment, although I don't own any stock in ChargePoint myself. That's pretty much it for today's video. Be sure to check out some of my other videos. I've got lots on electric vehicle charging, so be sure to check those out, and I'll see all of you in the next video.